Have you ever wondered why a human body needs to sleep 8 hours a day? Think about that. We sleep 8 hours a day on average. That means if we live to age 90, we would have slept 30 of those 90 years. 30 years! Imagine if we just didn't sleep, how much more productive we would be, how much more money we would make, how much more fun we would have. Of course, I'm being flip here. We know that we need those 8 hours every day to recharge ourselves, to go back out, be productive again, to move forward and charge through our goals. In fact, if we didn't sleep, we won't be productive at all. Most importantly, we won't live till age 90. I believe what the equity markets have been doing in the past quarter is just that. They have been resting after a long run higher since October of last year. Hi everyone, I am your portfolio manager Rajiv Dixit, and I hope you had a good summer and welcome to the market outlook video of the fourth quarter of 2021. Let's quickly recap the high points of our last conversation regarding financial markets. In our last outlook video, we reported to you that the equity markets were healthy, that we had a great run in the first two quarters. The small caps, the S&P 500, the Nasdaq, they all seemed in an upward trend at the time. We also reminded you that even though the markets have run up for the first 6 months, it is important to remember that markets do not provide periodic returns, which means it is highly likely that we could have a sideways quarter or even a down quarter after such a run up. And if it does go sideways, it would be considered a healthy consolidation. We have also been talking to you extensively about inflation this year. In June, we told you that the concern with inflation is that if the rising inflation is left unchecked by the Federal Reserve, it can be damaging for both the economy and the financial markets as a whole. Well, that story seems to have caught on lately with the media and, more importantly, the Federal Reserve. The Fed, in its most recent meeting last month, have now started to admit that inflation could be a bigger concern than they had previously assumed, and because of that, they are going to make policy shift to combat the rising inflationary tide. They have started talking about raising rates earlier than expected, and they are now going to start the process of tapering by the year end. This all is good news on inflation front. Well, relatively speaking. I think it is now a good time to talk about this concept of tapering that the Fed is planning on doing. To explain this concept, I want to use an analogy I recently heard. So please bear with me for a minute. Let's assume that you have a weight problem. Every year you go to your doctor and he tells you that you have gained 20 pounds again. Consistently. Every year you gain an additional 20 pounds. The doctor pleads with you to fix this problem. This year, you go for your annual visit and it turns out you've only gained 10 pounds. You put a positive spin on this and tell the doctor you are tapering. That, ladies and gentlemen, in a nutshell, is tapering. You still gained weight, still making the problem worse, but doing less damage than before. The Federal Reserve started to buy bonds back from the market in March of 2020 to combat the negative effect of the pandemic. The bond buyback program provided much needed stimulus in the economy. As the Feds bought the bonds, new cash flowed into the economy that helped generate new growth and development. The problem is that it also led to the side effect of high inflation. The Federal Reserve is now planning on slowing down that bond buyback program because it is concerned about inflation. That is the taper which is being talked about. Will it fix the problem of inflation? Maybe not, but it's definitely a step in the right direction. In Fed's defense, the reason they don't want to completely stop the bond buyback program is because they are worried of what's called a taper tantrum by the financial markets. That is, the markets will not like the fact they are not getting any more stimulus. But I think what the Fed is missing is the fact that the markets are now more concerned about inflation than they are about more stimulus. But I might be wrong. The noise section, as you all know by now, is the section in which we talk about the news that seemed important at the time it was happening, but really should be looked at as noise by a long-term investor. This quarter, I really don't have anything I can classify for you as noise. There really hasn't been anything in the news that qualifies as noise for a long-term investor. So let's take this opportunity to review the previous topic that we highlighted as noise and see how they are panning out. In April's Outlook video, we talked about Bitcoin in the noise section. At that time, Bitcoin was trading at $60,000. Yeah. Since then, Bitcoin has come down in value all the way to $30,000 level and is now trading around $40,000 to $50,000. But more importantly, since April, many governments around the world have raised concerns regarding regulation and taxation of Bitcoin. We still believe that the investment in Bitcoin carries significant risk of regulation and has serious valuation problems that will limit its ability to become your next currency. In the same Outlook video, we also put the GameStop stock debacle in the noise section. The GameStop stock that rose from a price of $20 to almost $450 in just 1 month was outlined by me to be just noise. As trading in things this volatile can be extremely dangerous for the long-term investor. Today, that same GameStop stock is trading at $170 and change. While it is significantly lower than its previous high, I would recommend a long-term investor to stay away from such volatility. Lastly, in the previous quarter, we talked about the fear that is being generated regarding the new capital gains tax proposal. We told you that while it is possible that the capital gains tax might be going up from the current level, the details in the proposal are so outlandish that they are highly unlikely to pass in their present form. A couple of weeks back, Gina did an excellent video talking about the continued changes to the original capital gains plan and how these changes are now becoming more realistic and have a much better chance of passing. As we predicted, the conversation around some of the extreme suggestions, like the step-up basis going away, has been removed from the plan. While we're on the topic of taxes, let's talk about planning for income tax savings. Most of us think about income taxes in April of next year, or at best, the first quarter of next year. I would submit to you that the best time to think about tax saving strategies is the fourth quarter of the current year. Now is the time when you should be reviewing the strategies you want to use to save on income taxes. There are not many actions you can take next year to save on income taxes of this year. If you are still working and have a 401k plan or a 403b plan, now is the time to look at your paycheck and see how much you have already contributed to this plan. Ideally, if you are able to max out the contribution limit, you should try to do that. See how far you are from reaching your contribution goals. You can adjust your paycheck for the remainder of the year to meet that goal. If you are a business owner, there are many actions you can take now that can help you reduce the tax burden for this year. Please review those now. Talk to your CPA. If you have questions or need our help, please call me or Gina so we can help you craft a strategy that will help you save on taxes. We are not CPAs, but we can point you in the right direction. This quarter, we are planning on inviting a tax expert as a guest speaker to talk to us about how to save on taxes and the current tax topics. If you have questions for this expert, please send them to us and we would be happy to ask them. Please don't forget to watch this important upcoming video. Gina did a video earlier this year about how to save on income taxes. It's a great tool to use as a guide when you are reviewing your current tax strategies. Please check that out as well. There are many actions we will be taking in your portfolio this quarter to help you save on taxes, but there is also much you can do on your end to help reduce this blow for yourself. Now, before we get to our current market outlook, I'd like to take a moment to share another outlook with you, a Parks Capital family personal update. The Griffo family has welcomed a new member this year. Yes, Gina has been promoted to the status of mother-in-law to a young man named Stephen. Gina's daughter Samantha said "I do" on October 10th. We wish them a lifetime of good health and happiness. In the Dixit family, everyone is healthy as well. My daughter Ria started high school this year and is trying out some leadership skills as the coxswain with her Pittsford crew team. My son Raj started middle school this year and has taken up the saxophone. With all that good, we want to also share some sad news. We lost one of our heroes this year. Our beloved friend, client, and longtime supporter, Richard G. Park, passed away peacefully at age 96. His humor and fun-loving spirit will be dearly missed. It's time to look at some charts, see what I'm talking about with respect to financial markets taking a bit of a rest. Let's begin with the chart we always start with. That is the monthly chart of the small cap index. As you can see here, I've been pointing this out for a while now. The markets broke out of this pattern in October of last year and had been running up since then until the month of June. After June, they broke away from this trend line and started to move sideways. This sideways movement doesn't look like much on a monthly chart, but if you dig deeper and look at the weekly chart of the same index, here you can clearly see that the markets were moving upwards in a pattern and are now moving sideways in a consolidation pattern between these two lines. They aren't really going down, even though on some days one might think they are. But clearly, the chart shows the markets are in a sideways consolidation. Same is the story with the Nasdaq index. Here, on a monthly chart, it doesn't look like much of a consolidation. But if you look at the daily chart of Nasdaq, you can see the markets basically coming back down to retest this trend line or resting a bit. They have tested this trend line on 3 prior occasions since the October breakout. So there isn't much of a reason to believe anything is broken here from a chart point of view. Just a simple, healthy rest. From a fundamental point of view as well, there are many catalysts still in place, like the $5 trillion stimulus running through the economy, or the recovery from the pandemic that can justify another run-up in the future. But since we run a rule-based risk management strategy, what we did back in July was that once the trend line on the small cap chart broke, we raised some cash in our portfolios. Took our foot off the pedal just a little bit, as I would say, to wait and see how the consolidation plays out. If the markets start to move back above this resistance, we can always put that cash back to work. But for now, a little caution is warranted after a run-up we have had in the past year. Let's look at the bond market real quick. Here, we have the 20-year Treasury chart as usual. As you can see, the chart bounced off nicely off the previous resistance and is now also just consolidating for the past couple months. It almost seems like a healthy consolidation is the story of this quarter across the board. It's almost like everything is waiting for something. It can be anybody's guess what that thing is, but if I had to guess, I would say all markets are waiting to see how this inflation story will play out with the Fed. That fact is most reflective in the monthly chart of gold. This is the monthly chart of gold. Gold has been moving up since the end of 2018 and now is also in a consolidation pattern above the support line, almost in a waiting pattern. A pattern very similar to the one seen in 2006 and in 2008. It's yet to be seen how all these charts will be resolved out of this consolidation pattern. But for now, they're just resting. I want to remind you again, the purpose of this update is not to predict the future. No one can do that. The purpose of this update is to inform you of what we're seeing and how we're preparing for it. Of course, if things were to change between now and the next 3 months, we would be reporting about those changes and how we adapt to them in the next update or our next conversation. We cannot close this piece without highlighting one obvious fact. The above views of the market and the narration of the events is a general view. You know that every portfolio in Parks Capital is managed based on who you are. Thus, they all look a bit different based on your risk tolerance and your individual goals. Please keep that in mind. We are looking forward to talking with each of you in your quarterly meetings, and remember, education plus investing equals to success.